This is the Financially Simple Podcast, the show dedicated to destroying the complexities of money for today's small business owner. The content in the show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor or conduct your own due diligence. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor only conducting business in states where it is properly registered or is excluded or exempted from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Here's your host, pizza-loving, certified financial planner, Justin Goodbread.
And welcome back to the Financially Simple Podcast. Today, we're still in our deep dive, specifically dealing with cash flow and as it relates to the personal finance section for us business owners. I have a special guest with me today on the episode. His name is Jonathan Payton. And Jonathan, like myself, is a certified financial planner. Welcome to the show, Jonathan.
Thanks so much, Justin. I appreciate you having me.
Jonathan, we're here to cover a particular topic today, but before we jump into this topic, I need to go over some disclosures that you and I have to deal with as practitioners in this world of finance. So, folks, Jonathan is a certified financial planner, and he also works in a registered investment advisory firm called Horizon Ridge Wealth Management. Did I get that correct, Jonathan?
That is correct.
Now, the reason why I've invited Jonathan here is because he is a chartered special needs consultant. And the reason why I've asked Jonathan here, folks, is because we're going to deal with a particular, I'm going to call sensitive topic. It's one that's near and dear to my heart because of many people whom I know is affected in this way. Let's say affected is probably not the right word. They deal with this. It's just part of life. And a question that I had come about was, should I pay my special needs child for my business? So that's the question we're going to deal with today. And just as a backdrop, what we've dealt with in the past few episodes, we've answered the questions like, should I pay my child from the business? Should I pay my spouse from the business? Should I put my spouse on the payroll? Well, one of my clients reached out and said, Justin, I heard your episode on should I pay my child from the business, but man, you know my child has special needs. I understand the situation very detailed, and they asked me some questions. And friends, I'm just not an expert in that area. So I reached out to the expert, which is why I have Jonathan here on the episode today with us. With that, Jonathan, did I hit all the disclosures that you and I have to deal with, man?
The only thing I would say is that we're going to go over a lot of great information today. And because Justin and I are pretty intelligent in a lot of areas, we are unfortunately not licensed tax advisors, nor are we accountants and or attorneys. So what we'll go over today is a lot of great stuff, but it is not deemed to be tax advice or legal advice.
Yeah, we talk about it all the time, folks. We talk about the three-legged milk stool, like the farm I grew up on. We want to have a good CPA, which is going to act as your tax advisor. I really want you to have a good business attorney or tax attorney. And then you got to have that certified financial planner involved, someone who understands business. You know, Jonathan and I were talking off the air, and we were, you and I, some would construe us as maybe competition. But I don't view it that way. I view us as experts in various fields. You have your own practice. You're a rock star to your own accord. I'm in a little different world. So, even though we are in the same industry, man, we're experts in our respective fields. So, man, I'm glad to have you here on the episode today. But, man, before we jump in this conversation, tell the listeners a little bit about who you are and how you came to be the expert.
I appreciate that, Justin. So my background in 90 seconds or less is simply this. I wanted to create a financial planning firm that was dedicated towards planning. Most of the people in my market tend to be more investment managers. They want to focus on the management of assets. And while we do that as a part of what we do, we wanted to be a specialist. And in fact, we became specialists in a number of areas. So our target demographic, much like yours, is the entrepreneur and the executive. But we focus in on things like special needs planning, divorce planning, financial planning, obviously, but senior care planning, alternative investments, and a number of other things. And the key for us is that because we can be planners first, we can start with the plan in mind and the end in mind. Everything kind of falls into place from that. And so whether it be the personal planning side or the executive or business planning side, we try to bring it all together to help the listener or the client better understand what are potential obstacles in their way and how do we potentially dodge those obstacles or potentially just go right through the obstacle and no longer make it an obstacle for us. And so today I think I'm up to 12 total certifications, degrees, and designations. because I always wanted to try and look at things and problems from so many different angles, because at the end of the day, as you know this, Justin, no problem can be solved looking at it from one vantage point. You have to look at it from multiple vantage points. And for me, specifically in today's episode, part of the reason why I became a chartered special needs consultant was because my oldest daughter is special needs. She is on the ASD spectrum. And I think about my own personal experience of raising a special needs child and what it takes to help prepare them in the world, and how do you protect your own investments, and how do you kind of transition assets to them. Those kind of are questions that I didn't fully understand. And so for my own personal edification, I had to kind of go down that path, which then, of course, led me to helping other people along the way in this particular category.
Man, folks, I don't know if you heard the passion in Jonathan's voice. Man, I love it, brother. I love it. I love the fact that, first of all, you are a CFP and you put your clients first. I love the fact that you and I can have a conversation and not feel threatened. But I love most of all the fact that you mentioned clients first consistently. Just that explanation about who you are as a father. And so, man, I'm humbled to have you on the episode today. I know people are going to get lots of good, valuable content from this. So let's chat through the conversation now about, should I pay my special needs child for my business? Okay, so that's the reason we're here. So to unpack this, I mean, this could be really detailed. In fact, you and I were talking before we started the show about lots of in-depth research. So we're going to try to keep it simple today. You and I have talked about that. But let's start with the very basics about why am I even asking the question, should we put our special needs child on the payroll? What could paying your special needs child help or harm them in their future? How could it help or harm them? Maybe there's a better way to ask that.
That's a good question. I think there are two elements of this question. One is the psychological element and one is the financial element. A lot of times, like you, I'm sure we ask the question to the potential client or actual client, do you care about all of the minutia and the technicals? And do you want to just pay them as an employee and let them get the satisfaction of being an employee? Or do we want to try and, in essence, game the system, right? Or try and squeeze as much money out as possible in order to shelter money from taxes and so forth? And I would tell you that there's two different sides of the fence here, and both sides of the fence have valid arguments. For this conversation, focusing on the technicals, I would make the argument that you can do a number of things to position your child in a manner to where they are still able to generate an income for themselves, help support themselves, help them feel like they are becoming a contributing member of society, feel like they have control over their finances. And again, this all depends upon the type of disability that they may have, but it also allows you to be able, and them to be able, to shelter income and potentially lower their tax liabilities so that you can transition money out of the business to them and potentially into a special type of trust that would benefit both them today and them in the future.
Okay, that's a mouthful. So let's unpack that. Let's dig down a little bit on all that. Okay, so in the past few episodes, I've talked about how putting your children on payroll will help benefit the business through the tax deduction. So let's not dive too deep there. I've also talked about how we can pay up to theoretically $12,000 depending on the child's roles, and that be tax-free income. But there toward the end of that conversation there, that dialogue you just had, you talked about a special needs trust. That comes up a lot with us as planners whenever we're dealing with clients who have special needs. Talk to me about why you mentioned special needs trust and specifically how it could help or harm the child.
Sure. No, I appreciate that. So let's just tell a story, because I think that stories tend to be the easiest way for people to understand things. And I'll use my own personal example. So my daughter, being on the ASD spectrum, will probably never qualify for government benefits because she's able to do a number of things. Those that can qualify for government benefits need to understand and assess how to shift income or potentially pay income to their special needs child. And if they do it the right way, they can potentially maximize things like Social Security income or Social Security disability income. But if you do it potentially the wrong way and you are just transferring money to them, you may disqualify them for benefits. Now, why is that all important? Well, when you look at Social Security income or Social Security disability income, right, SSI or SSDI, that's not necessarily going to be enough money for them to sustain their standard of living. And so when you look at then transitioning assets to them or income to them, you may potentially preclude them from being eligible for one or both of those income streams. Now, why is that important? Well, if we use a special needs trust as opposed to a regular revocable trust, we have the ability to not necessarily exclude them from those government benefits. I'll go one step further and one step deeper. So in the world of income planning and estate planning, as anyone may have a child or an individual who is not special needs, you can set up a revocable trust and transfer assets to them, or an irrevocable trust and transfer assets to them. And I'm sure Justin's already covered that in a number of episodes beforehand. But in the special needs world, you have what's called a self-settled trust, which is one that is created by the owner, i.e. your child, and they can shove a whole bunch of money into it. The problem with a self-settled trust is simply the fact that when a child puts money into it, the beneficiary of that trust has to be the state or Medicaid in the future because they want to get paid back for the benefits that were paid out over time. Now, we can unpack that a little bit later. That has some pros and cons to it. But the other side of it is the supplemental or the third party special needs trust, where in your situation as the business owner, you may look at the equity in your business or income from your business and say, if I can funnel money into that type of trust, which is essentially an irrevocable trust where you're gifting money into it, that money can build over time, or the asset can build over time. That asset or income can then be excluded from the child's estate, which means it does not count for income benefits associated with government benefits. So let me pause there, Justin. I probably threw a whole lot at you and them. So what can we unpack further?
Yeah, so let's go back to the basics here. So an irrevocable trust for the listeners, and we touched on this in the past, but let's just kind of define that term. It means that once we make a decision, we can't change it. That's the simplest way I can describe that. Is that a fair definition, Jonathan?
The irrevocable trust, yes. If you make a decision today, you cannot change it in the future.
Okay, and then you broke that up into two different, when I was trying to follow you, two different directions. And the latter direction was the one that you kind of leaned to the business owner on. Can you hit that one more time, and let's break it down like you're talking to my 8-year-old, if possible? I know we're dealing with some technical things, and guys, I'm sorry,
Yeah.
Jonathan and I deal with these things, and it's hard sometimes for us to break them down. Let's go back to that last little section about the trust and how the business owner can shift things around. Let's just say that one more time.
So let's use myself, the business owner, and my daughter, the actual child, right? So if I gave my child $100,000 in her name, assuming she qualified for government benefits, then the problem is that because she has that asset, she would no longer qualify for government benefits. So in turn, what she would have to do is just create a self-settled special needs trust. She's allowed to basically keep $2,000 to her name. That's it.
Right.
By depositing the other $98,000 into this trust, she now qualifies from an asset side of it to be able to receive government benefits. Now, the advantage is the $98,000 can be invested however she wants,
Right.
and income can be paid out to her for supplemental support. Now, that's
And the reason why
child side.
the reason why that's important for supplemental support is it doesn't affect any of the support she would be getting from the government subsidies.
Correct, because think of it this way. The government provides benefits for eats and sheets, right? Food and shelter. And so when we think of it from that logical perspective, the vacation, the extracurricular things that the child might want to do would be paid out of that trust so that it does not impact the income they would receive from governmental benefits.
I'm with you.
So that's what this self-settled trust would look like. On the other side of the coin, there's the supplemental or third-party special needs trust. And in that side of the fence, it would be I, the business owner, can do one of two things. I can transfer or gift income or cash, if you will, into this trust, which is held outside of the estate, meaning the child does not own the asset. The trust owns the asset. It's irrevocable. But the problem in that scenario is that you might not be able to transfer as much, and it might not be very tax efficient. So another example that you and I are familiar with is you might be able to take the equity in your company and transition that money over. So that way, if the third party or supplemental trust owned equity in your business and you sold that business in the future, right, that immediate gain or that tax liability and that asset would then again be held in there. It's a nice way to fund that trust. Similar to the self-settled trust, the benefits of the third party trust for us business owners is that we can then transfer things out of our estate, we can transfer things out of the child's estate, but we can also benefit them and not preclude them from receiving government benefits. I got more to go into there, but let me pause there for any questions you might have.
Yeah, so let me just repeat what I've just heard. I'm going to try to simplify this down. Again, folks, Jonathan and I deal with this on a daily basis. I'm over here thinking, trying to get myself out of a certified financial planner mindset and go back to basic questions for those of us who don't talk geek like Jonathan and I are currently doing. Let's go back one more time. Let me just see if I can say what I heard back to you. Okay. I'm a business owner.
Please.
And I want to do some planning, and I have a special needs child. If I open up or I direct positions, money, stock of the company, membership units of the company, cash, maybe life insurance proceeds, I can place those into the special needs trust for my child. Did I say that part correct so far?
If it's a third party
Correct.
Or a supplemental, correct.
Okay, so a third party trust, I can direct things for my child. Now, what I want to get ultra clear on here is, why does that matter for my child?
Perfect. I'm glad you went there. So again, in the first scenario, we talked about giving the money to them. In the self-settled trust, because the money has to be paid back to the state or to Medicaid, obviously that doesn't necessarily leave as much money to other beneficiaries who may benefit from the money that was gifted to the child or so forth. So again, my daughter, if she had $100,000 and I wanted to make sure that some amount of that went on to my other daughter, that she wouldn't necessarily have enough money to potentially bequeath to the second child. On the other side, the third party trust, that does not have to get paid back to Medicaid or to the state. So again, I have $100,000. I've given it to the third party special needs trust. That money can be used for the benefit of my daughter. If my daughter passed away, anything in that trust would then be able to get transferred on to another heir or beneficiary and so forth. So it's really about control in that scenario. Where do you want that money to go? And it also depends upon, again, how much money you think you need to take care of your child and which type of trust is a more appropriate avenue for you. But in most cases, because so many people that I've worked with over the years do not understand just some of that little nuance, they end up accidentally transferring money to their child through a traditional revocable or even irrevocable trust, and the child takes ownership of it, which precludes them from government benefits and forces them to create the self-settled trust, the one that they create, which means that then any remainderment in that trust would have to go back to the state or to Medicaid, which may not be the direction or the benefit of the company or the benefit of the family as a whole.
Now, and I'm asking the question because I don't know this answer. Is it the full remainderment, or is it just to pay back the funds which have been paid from the government?
Great question. So it's to pay back the benefits of the government. Now, the key is that in most cases, the benefits paid by the government are using essentially government rates. So if you were to look at private rates versus government rates or what is approved by Medicaid would be typically lower than private rates. So that's one of the advantages of using a self-settle. But again, hypothetically, using rough numbers here, if government approved rates are $10 and private rates are $20, and I have to pay back 10, then some amount of money might get passed on, but not necessarily as much money that could be passed on if you used the third party trust instead.
Okay. I'm with you on everything we just said. I think we explained that in as simple terms as possible, and understanding that the third party versus a self-created special needs trust are two different ways we can shift assets. But I want to pull us back. And let's talk about a little bit, Jonathan, if we may, or unless I'm missing something here that we need to flush out even further. Let me stop there and see if there is.
I think from an asset perspective, we've hit on kind of the highlights of the two strategies. I think now it's time to probably shift to income.
Yeah, that's where I want to drive to now, is to the income perspective. And specifically, let's deal with maybe like in your family situation or my client situation where they're dealing with a 15-year-old. His friends are also business owner kids, and they're working and talking about, hey, I'm helping dad in the business, doing this, that, and the other, helping mom. And here he was being left out, and they're trying to figure out, hey, Justin, should we place our special needs child into the business like our friends have done with their kids who are not special needs? And if we do that, what are we going to do as far as income damage or benefit as it relates to the government subsidies, as it relates to long-term planning for that special needs child? Is that kind of the direction you were heading in next?
That's a good starting point.
Okay.
And I think it kind of circles back to one of the first comments, questions that you and I put in, which is, what is the real advantage here, right? Do we just want to put the child on payroll and make them feel emotionally like they're a contributing member of society and they feel like they can control their future? Or do we want to try and game the system? So let's talk about gaming the system for a hot second. And again, I use that phrase kind of loosely because it's not really gaming. It's more or less trying to manage the tax liabilities, ups and downs. But from an income point of view, assuming you, the listener, are not retirement age, meaning you have not physically retired and you're not collecting Social Security benefits, if the child is collecting SSI or Social Security income, essentially what they're doing is that they are limited or capped as to how much income they can receive on a federal level. Right now in 2019, it's $771. Now, different states may provide an additional supplement saying that they could collect potentially more. Some states $10, some states up to $700 more. What that allows them to do is that, again, allows them to have their own income to do with it what they will. So I'm going to try and not go super detailed here because I can get really geeky, but try and follow me here. So if I'm the business owner and I know that I have certain limitations, I can look at figuring out how much to pay my child. In the example that I tend to use with clients is, if I were to pay my child $1,600 a month in employment wages, the first $20 of unearned income is taken off of that calculation. Then the next $65 of earned income is taken off of that calculation, which basically, to determine the benefits that might be paid by the state, would say that there's $1,515 left over that the child would be deemed as receiving countable income.
Right.
Now, again, from a calculation perspective, we would divide that by 2, which would be $757.50. And again, because eligible benefits paid out by SSI are $771, I would subtract $771 from $757.50, and I would basically get $13.50 of eligible benefits paid by the federal government. So it's a lot of information, but what I want you to understand as a listener is that you are essentially capped at what you could potentially pay them. And the question then becomes, is that cap too much or too little to make them feel like they are getting the most out of it, or that you're giving them enough money that you would want to essentially give them? Because $1,600 a month, and again, based on the numbers, would only actually pay them approximately $13.50 per month from SSI, which means you're not really getting a whole lot of money from SSI. And therefore, you'd have to drop your amount of money you would pay them down significantly in order to try and maximize what they would get from SSI.
Jonathan,
I have more to go over, but let me pause there.
Yeah, right there. I think you were coming to the point that I was arriving at in my head. I heard the calculation. You and I have talked about this in the past, on a level in the past. I've looked at this, but let's boil it down to, what is that number, that point to where if they cross over that threshold, that it's like, hey, look, this may not be a wise short-term planning decision if you're trying to maximize that SSI benefit.
So I would love to tell you there's a perfect number for that, right? And the reason I say that candidly is for two things. And again, I don't want to get too geeky here, but this is why from a business perspective, it's very important on understanding how you look at the type of income you pay. So I'll give you three things that can be considered from a business owner point of view when hiring your child and how that can affect the income that would be considered countable income, which ultimately gets to your question, Justin. Mm-hmm. So first of all, there are potentially, depending upon the child's disability, there are impairment related work expenses that might be able to be deducted against income. So for example, if my child could not drive to work and had to call a cab or an Uber, those fees could be considered work-related expenses and therefore could be deducted against the income that they would receive, which of course would lower their countable income. So that's number one. And because impairment-related expenses can be, again, things like special equipment, training, or transportation expenses, you could potentially be seeing $1,000 a month in those expenses, which essentially could increase what you would pay the child, again, to allow them to have more income and fundamentally pay those bills to, again, feel like they are a contributing member of the family, but also taking control of their life. So number one is impairment-related work expenses. Number two, when you think about it from a special needs perspective, and again, this is where we get into, again, the geeky side, so bear with me, listeners. If your child opened up their own business, maybe it's a consulting firm, maybe it's something that you could outsource to them in some capacity, they become their own small business owner, which means there are obviously certain benefits associated with that. Things like they can write off their own expenses, right? And so things that, for example, hypothetically, there was a cell phone bill, right, that was used for business related purposes, or other types of things, again, transportation related or work expenses. Again, you can technically try and shelter some of the expenses underneath their business. And whatever is net of that, meaning the net income associated with that business, would be deemed as countable income. So another way of trying to, quote unquote, manipulate and legally get the system to where you can pay the child more, but still try and manage what their countable income is by government standards. And the last thing I'll throw at you today is, and this is where it gets a little bit crazy, because you actually have to work with a special needs attorney or accountant to really gauge the amount of income you can pay here. But you can go to the SSA.gov and you can search subsidy and special conditions. And underneath this section, and I wrote this down verbatim because I didn't want to mess it up for your listeners. It says basically a subsidy is the extra amount of wages an employer pays an impaired individual for services over the reasonable value of actual services performed. If the individual is not fully earning his or her wages because the work is performed under special conditions, then we must reduce part of the wages not earned from average gross wages. So essentially what it's saying is, if your child is an employee and someone is supervising them all the time, there is a potential way to look at what they are doing versus what is being supervised to break out how much of the wages are actually associated with their work productivity versus wages that are associated with someone who is essentially supervising them during a specific period of time. In that type of environment, and again, this is where you get into the minutia here because certain expenses have to be approved, but in that type of environment, you might be able to pay your child well above what would normally be deemed as countable income. And because of that separation between what they have essentially done by themselves versus what someone who has supervised them do, could actually benefit them more. Now, let me pause there because that's a lot to unpack.
Yeah, so I'm just going to say back to you in a few sentences what you just very well articulated. The first one is talking about how much can we pay the child is there are some expenses that are able to be deducted against the income, i.e. you use the example of travel expenses, Uber specifically is what you stated. And that's one way to classify the income. The second way, which we hit on, which I love, capital LOVE, was having the child have their own business, maybe as like a consulting firm, a 1099, a sole proprietor, sole prop, something of that nature. And potentially the income could be greater because now you are potentially using other expenses in that new business model. That's the second one you hit. And did I say that right? Close enough?
You hit pretty close, yeah.
Okay, good. The third is that if we're having to have a supervisor who is having to manage, I'm trying to break this simple, so I think I'm going to lose some of this in translation. If we have to have a supervisor there to help the child or supervise the duties of the child, then we potentially could pay even more than the first example we gave because of having a supervisor involved in that situation. Did I butcher that third one?
The last one essentially is this. When we think about our own individual work productivity, right? In a day, I can hammer out 5 widgets and the child can hammer out on their own 1 widget. But with a supervisor, they're able to hammer out 3 widgets. The assumption is the income that was paid for the extra 2 widgets would no longer be deemed their productivity and thus could be excluded for countable income purposes when determining government benefits. And again, the key here is that it's not like I'll just randomly pick a number. You have to work with a qualified attorney or accountant to really understand that fine line, submit it to SSA for approval so that you make sure that you're not, again, limiting those government benefits.
Wow. Okay. So we're pushing a lot of information here. I want to recap in a very quick fashion what I've heard thus far. But before I do that, Jonathan, I wanted to see if there's any other major high mountaintop areas as it relates to the question, should I pay my special needs child for my business, which we haven't yet bounced across?
I don't think so. Again, beyond the question of what's the real goal? Is it you want to make them feel like a contributing member of the family and or society, and you want them to have control of their life and pay them an income, and all of this minutia kind of falls to the side, or you want to actually focus on that? To me, those are the 2 primary paths, and you got to figure out where you're going to start from in order to figure out how to kind of go down the respective path.
And that's really not a technical answer. That's a lifestyle and a preference answer. Am I right?
I would agree with that. I mean, the technicalities come determining which path you go down, but you're absolutely right. It's truly a lifestyle answer and the kind of lifestyle you want your child to have.
So we began the conversation today talking about those 2 paths, and we dove off into the fact that there's 2 primary types of special needs trusts that we can use for asset preservation. One being a third party, one being, you called it a self-directed?
Self-settled trust.
Self-settled trust. I'm sorry. Yeah, self-settled. So one being the child sets it up, one being potentially a parent. Does it have to be a parent, or can it be a loved one? Can it be a grandpa, a grandma, aunt, uncle that sets up a third party trust?
It's literally, as you pointed out, it's a third-party trust. A third party would set it up.
Okay, and so in theory, on that third-party trust, the business itself could set up a third-party trust.
Not necessarily. It has to be an individual. So to your comment, it could be the grandparent, the sibling, the parent, somebody, but it couldn't be the entity.
Okay, same rules apply. Okay. So we have 2 different types of trusts that we can utilize for long-term planning, specifically around perhaps estate planning, exit planning of the business, things of that nature. And then we kind of dovetailed into the question of, okay, let's say now we do, in fact, want to pay the child out of the business. In that capacity, we just identified 3 different metrics to pay the child of the business. One being you pay them for services rendered, trying to maximize SSI benefits. And as we said, when I asked the question, hey, what's the number? And you and I would often say it depends, except you didn't say that. Kudos. Good job. I would try to avoid that as well. Instead, you articulate it so much better with examples. But we could pay the child of the business, or we could have the child set up their own business. Finally, if we had a qualified CPA or attorney involved, then we may be able to add some extra benefit if we have a supervisor that's helping us in those situations. I know I just oversimplified that, but I hit the high points.
I think you did a good job of hitting the high points there, but you're right. There is a lot of detailed information, and while a lot of financial planners are versed in a lot of great areas, this particular area, because it involves the question of government benefits and how to protect assets, you really need to work with a qualified person like Justin or myself who understands these nuances, because you don't want to go down the wrong path, set something up, think that you're all good to go, and then all of a sudden be surprised in the future when your potential loved one is put in a bad position.
Yeah, folks. And with that, we're going to kind of bring this plane to landing here. I want you to listen to the heart. You hear me talk every week, and I get technical, and I'm silly oftentimes, but listen to the heart of a daddy. Listen to a Harvard planner here who is dealing with something he personally has walked through. This is the reason why I asked Jonathan to be a part of the show. It's not because I'm not capable. It's not because that there's other planners aren't capable. But, man, whenever you have somebody who's lived it, like in my world, I've started and sold 3 businesses for a profit. I know what it's like to start and grow a business and sell it, but I don't have a special needs child. I do not know. I am not a specialist, even though you just said I was, Jonathan. I'm not a specialist when it comes to dealing with special needs children, especially the area of the code. I would dare say that many tax advisors, CPAs, many tax attorneys probably also are not specialists. And so, friends, you've heard me say in the past, whenever you're dealing with your life, no one knows your life better than you. And you have to find those players that fit on your team that has walked in that same journey, maybe not identical, but in that same journey that you're on, and who are specialists in of themselves in this area that you're walking in, which is why I wanted Jonathan to come on and join us to talk about this particular area. Man, I am so glad you came on today. You've taught me a few more things today. It's always a pleasure to chat with you. But let me ask you this last question, Jonathan. If people wanted to, just say, hey, man, I've got a special needs child, I need some help, how could they reach out to you? Where would you send them to? How would they get a hold of you?
Yeah, so they can obviously visit our website, hrwmgmt.com, for Horizon Ridge Wealth Management, and they can learn more about how we approach special needs planning. Or they can download what we created for our special needs families, our guide to financial planning for special needs families. And they can see that at info.hrwmgt.com/special-needs or special-needs. By doing that, you can download an ebook that walks you through some of the basics that we covered today, special needs trust, income planning, and so forth, to better assess where you are in your phase of life. And the bottom line ends up being is that, as Justin pointed out in the very beginning, it's all about quality of life, and it's all about the emotional versus the technical. Once you figure out which path you want to go down, you can then begin to navigate who might be the best fit for you.
Brother, I'm so excited that you came onto the show today. And friends, we're going to put a link to both of those URLs that Jonathan just articulated. I have them already both on my notes. And so we'll make sure we have them there in the show notes below, whether you're listening to iTunes, Spotify, Stitcher, wherever. You'll be able to get a link directly to Jonathan's team. They're doing some rock star work, and highly, can't speak highly enough to recommend them if you're dealing with this particular area of planning. If you have a special needs child or know someone who has a special needs child, you want to work with the expert, which is why I brought Jonathan on the show today. So take a look at those links there. And when the blog is up, check it out on financiallysimple.com. We will have this episode transcribed, and we'll have the show notes there as well with the links in the description. Jonathan, is there anything else I missed, or is there anything that we would need to say before we jump off the air here today?
No, I think you've done a phenomenal job, Justin, and I want to thank you very much for having me on today. I love being able to share this side of it because I'm so passionate about what we do and how we help individuals in this space. I think it's an underserved market because there are unfortunately too many people that need the help and too few people that know how to help them. So I really appreciate you kind of shining a light on this for us.
Brother, I am so honored to have you as a guest today. And with that, I sign off every week by saying life is hard. And today's episode brings a little bit more realism to that. Life is hard, but life is good. Life can be frustrating, but money doesn't have to be. Hey, look, let's continue to make our lives at least financially simple. Y'all go out and make it a great day.
You've been listening to the Financially Simple podcast. For more business and personal financial help and information, head over to financiallysimple.com today.